KOSPI edges up 0.88%. Now, I know our favorite little mascot Lauro might be celebrating the green on the board today, but honestly, don't let that headline number fool you. It's masking a massive underlying divergence. What we're actually looking at is a market literally splitting into two entirely different realities. So let's dive right into this explainer and see what's really going on. So while the headline shows this narrow victory, closing at 6,912, the reality of today's market is just a fierce battle. It is a direct, head-on clash between macroeconomic headwinds dragging us down and some very specific microeconomic tailwinds pushing us up. Let's tackle that macro pressure first. The macro squeeze all starts with oil. You've got the U.S. planning stronger sanctions on Iran, right? And that is keeping WTI crude stubbornly elevated at $86.33. Even with a slight daily dip, the absolute price level is still really high. Supply risks from the Strait of Hormuz are just keeping the entire market completely on edge. And then you look at Brent crude. Brent is crucial because it directly impacts Asian energy import costs, and it just surged over 2% to $93.78. High oil prices basically lock in near-term inflation pressures. When energy costs stay high, inflation expectations stay high. And what does that do to the whole interest rate equation? It completely flips it. Here is the chain reaction in real time. Persistent inflation expectations basically crush the probability of near-term rate cuts. As a result, the U.S. 10-year yield was forced up 5.6 basis points to 4.702%. The bond market isn't waiting around. It's reacting instantly to the sticky inflation data. And those ripples, they hit Asia immediately. Following the U.S., Korean short-term bond yields are facing immediate upward pressure. The Korean 3-year yield jumped 4.2 basis points to 3.853%. Simply put, the cost of money is going up across the board. Moving to the long end of the curve, right in Yeouido, Korea's financial hub, the Korean 10-year yield rose by a very similar margin to its U.S. counterpart. The whole financial environment is tightening, and that means borrowing costs are rising for everyone, from massive corporations down to everyday consumers. So how does this actually hit the stock market? Well, it's a pretty brutal mechanical sequence. Oil goes up, yields spike, suddenly the discount rate applied to equity valuations shoots up. Mathematically, this lowers the present value of future cash flows, which just pulls stock prices down globally. It's not sentiment, it's pure math. But despite all that downward gravity, the KOSPI somehow defied the odds today. Why? Well, it's entirely due to a massive counterweight from the semiconductor sector. While the broader market was drowning in rising rates, tech giants basically created their own micro-level tailwind. Korea's two memory giants, Samsung Electronics and SK Hynix, stepped in and introduced some extreme shareholder return catalysts. And look, these aren't just your run-of-the-mill minor adjustments. We're talking about highly aggressive capital allocation strategies designed to instantly boost shareholder value. To really get why this is a big deal, we have to distinguish between the two methods they're using. Dividends, as you know, distribute cash directly to shareholders, but buybacks with cancellations, they permanently wipe out a portion of outstanding shares. This artificially raises the per-share value for everyone still holding the stock. Both are great, but cancellations literally alter the DNA of the share structure. Let's put some numbers to this. SK Hynix is currently executing a massive 40 trillion Korean won share buyback and cancellation plan. That announcement totally blew market expectations out of the water. It injects this massive direct purchase demand right into the order book. Compounding that, reports indicate Samsung Electronics is gearing up to approve a staggering 90 to 110 trillion won shareholder return plan. I mean, we're talking about a truly historic amount of capital being returned to the market here. The sheer scale of this is enough to single-handedly move the entire national index. And the market reaction? Instantaneous. Samsung Electronics stocks surged 3.87%. These unprecedented buyback and dividend expectations injected this wave of pure upward momentum into the company, completely overriding all those macro rate pressures we were just talking about. But here's the catch. This created a severely distorted market. The divergence is actually kind of staggering. Large caps, which are obviously dominated by tech, rose 1.2%. Meanwhile, mid caps dropped 2.4%, and small caps took a 1.8% hit. So the index looks green, but under the hood, the majority of companies are bleeding. The mechanics of Samsung's expected buyback also sent a highly specific ripple effect straight through its financial affiliates. Because you see, a buyback doesn't just impact the parent company. In Korea's super complex corporate structures, changing the share count triggers a massive chain reaction. Here is exactly how the dominoes fall. Samsung Life Insurance holds an 8.51% stake in Samsung Electronics. They are a massive institutional holder, meaning any change in Samsung Electronics equity directly, and I mean directly, impacts Samsung Life's balance sheet. Think about the math for a second. If Samsung Electronics cancels shares, the total number of outstanding shares falls, right? This automatically increases Samsung Life's ownership percentage, even if they don't buy a single additional stock. Their slice of the pie gets bigger simply because the pie itself shrinks. But there is a catch: the regulatory ceiling constraint. These financial affiliates face incredibly strict regulations tied to their ownership percentage in non-financial companies, like Samsung Electronics. Crossing certain ownership thresholds isn't just a technicality, it carries severe regulatory weight and massive compliance headaches. So anticipating that Samsung Electronics might favor special dividends to dodge those exact regulatory headaches, capital absolutely flooded into the affiliates today. Samsung Life spiked over 10%, Samsung Fire rose over 6%, but look at the non-Samsung insurers. They actually fell. It was an incredibly targeted trade. The final piece of today's puzzle lies in the hidden signals of foreign institutional flow. If we really want to know what the smart money is doing, we have to follow the foreign capital. And right now, they aren't buying the Korean market as a whole, they are buying a very, very specific catalyst. The result is this extreme market concentration you're seeing. Massive green gains for the semiconductor giants, while the rest of the market is just a sea of red. Make no mistake, this is not a broad market rally. It is a highly localized structural event. The data proves it perfectly, too. Foreign investors net bought over 445 billion won of Samsung and SK Hynix combined today. Yet, at the exact same time, they ruthlessly dumped over 616 billion won of the broader KOSPI. They are literally stripping capital from the general economy just to fund this tech trade. So today's 0.88% gain, definitely not a broad market victory. It was a highly targeted concentration of capital. Investors are basically seeking safety in the isolated shareholder return catalyst of two tech giants, while entirely abandoning a broader market that's being crushed by high oil and rising yields. Which leaves us with a pretty critical question. If the broader market is crumbling under the weight of inflation and high yields, how long can just two tech giants hold the entire KOSPI up? Are we looking at a truly resilient tech sector, or just a beautiful facade hiding a cracking foundation? Let me know what you think. And hey, if you want to receive news on the closing of Asian stock markets before the New York bell rings, make sure to hit subscribe. See you next time.